Have you ever stared at your retirement account options, feeling like you're trying to decode ancient hieroglyphics written by caffeinated financial advisors? You're not alone. When most people open up their 401k menu for the first time, they're greeted with a bewildering array of fund names that sound like they were generated by throwing alphabet soup at a wall. Large cap growth, mid cap value, international emerging markets, target date funds, sector funds, balanced funds, stable value funds, bond ladders, lifestyle portfolios. For most people, that first look at a retirement plan doesn't feel empowering at all. It feels intimidating. Instead of confidence, there's confusion. Instead of clarity, there's anxiety. Somewhere inside that overwhelming list sits a simple option that almost everyone ignores at first glance: the S&P 500 Index Fund. You've probably heard the term S&P 500 more times than you can count. It shows up in news headlines, flashes across financial TV screens, and gets casually dropped in conversations by coworkers who recently discovered investing podcasts and now think they've cracked the code. Yet despite how often it's mentioned, most people don't actually understand what it is or why it matters. Maybe you've seen headlines saying the S&P 500 had its best day in years, or that it plunged on recession fears. Maybe someone bragged about beating it, or maybe you've quietly wondered whether this mysterious thing is something you should invest in, or just another financial buzzword designed to make you feel behind. The truth is, the S&P 500 isn't just another investment option. It's one of the most important financial tools ever created for everyday people, and understanding it can change the entire trajectory of your financial life. My name is PPS, and I spend way too much time thinking about money, investing, psychology, and why smart people still manage to sabotage their own financial futures. If your goal is to build wealth without drowning in jargon or needing a PhD in finance, you're exactly where you should be. Most people don't avoid investing because they're lazy. They avoid it because the system feels hostile. The language is confusing, the options feel endless, and the fear of making a mistake is overwhelming. On top of that, modern careers are unstable. The average person will change jobs multiple times during their working life. And every time that happens, they're handed a brand new retirement plan with completely different investment options. One employer might offer 12 funds. Another offers 40. Another offers 60. Each plan uses different names, layouts, and marketing language. Some options sound exciting, like aggressive growth portfolios, while others sound painfully dull, like stable value funds. Yet almost every plan has one thing in common. Buried somewhere in the list is an S&P 500 index fund, and that consistency is not an accident. At its core, the S&P 500 is an index. An index isn't an investment by itself. It's a measurement tool. Think of it like a scoreboard. It tracks how a specific group of companies is performing over time. The S&P 500 follows roughly 500 of the largest and most influential publicly traded companies in the United States. Businesses that generate enormous revenue, employ millions of people, and shape the global economy. When people say the market is up or the market is down, they're usually talking directly or indirectly about the S&P 500. But this index isn't random. Companies don't get added just because they're famous. There is a committee whose job is to decide which businesses earn a spot, and the requirements are strict. A company must be based in the United States. It must be publicly traded, worth billions of dollars, profitable, liquid, and have a proven operating history. This process filters out speculative businesses and short-lived hype. When you invest in an S&P 500 index fund, you aren't gambling on untested startups. You're buying ownership in companies that have already proven they can survive competition, recessions, and massive economic change. Think about the companies that dominate every day: Life, Apple, Microsoft, Amazon, Google, Nvidia, Tesla, Meta, Berkshire Hathaway, Johnson & Johnson, ExxonMobil, These aren't just recognizable names. They are businesses that define how we work, communicate, shop, and live. Most of them sit inside the S&P 500. When you invest in an S&P 500 index fund, you're buying a small piece of all of them at once. One decision gives you exposure to hundreds of elite companies across technology, healthcare, finance, energy, and consumer goods. That's diversification in its purest form. An important detail most people miss is that the S&P 500 is market cap weighted. This means larger companies have more influence on the index than smaller ones. If Apple rises, the index moves more than if a smaller company rises by the same percentage. Today, the top 10 companies control roughly 35 to 40% of the index, reflecting economic reality rather than bias. This structure ensures your investment naturally shifts toward businesses that are succeeding and away from those that are shrinking. It adapts without emotion, prediction, or human interference, and that's a major reason it works so well. For decades, researchers have compared actively managed funds to the S&P 500, and the results are consistently brutal. Over long periods, roughly 85 to 90% of professional fund managers fail to outperform the index after fees. That means most people who are paid to beat the market simply don't. Markets are competitive. Millions of investors analyze the same information, and prices adjust almost instantly. Any obvious advantage disappears quickly. This reality is explained by the efficient market hypothesis, which states that stock prices already reflect available information. Trying to consistently outsmart the market is like trying to outrun your own shadow. Fees make this problem even worse. A 1 or 2% annual fee doesn't sound dangerous until it compounds over decades. Those fees don't just reduce returns. They steal future growth. Over a lifetime, they can cost you hundreds of thousands of dollars. Index funds, on the other hand, charge almost nothing, and that difference alone can determine whether you retire comfortably or struggle financially. This is why Warren Buffett has repeatedly recommended S&P 500 index funds for most investors. He even bet hedge fund managers that a simple index fund would outperform their complex strategies over 10 years. The hedge funds lost badly, not because they were stupid, but because simplicity beat ego. Historically, the S&P 500 has returned about 10% annually before inflation. That doesn't mean every year is positive. Some years are painful, others are euphoric, but over time, the trend has remained remarkably consistent. Compounding turns ordinary contributions into extraordinary outcomes for investors who are patient. Market crashes scare beginners, but experienced investors understand something crucial: downturns are opportunities. When markets fall, your money buys more shares. When the market recovers, as it always has throughout American history, those extra shares become incredibly valuable. Bear markets are temporary. Ownership is permanent. The investment industry sells complexity because complexity justifies fees, but wealth is built through consistency, discipline, and time. The S&P 500 removes emotion, guesswork, and ego from investing. You don't need to be right. You just need to stay invested. The S&P 500 isn't flashy. It doesn't give you bragging rights at dinner parties. What it gives you is ownership in the American economy, and over decades, that have proven to be one of the most powerful wealth-building strategies ever created. The smartest move isn't the one that sounds impressive. It's the one you can stick with for the next 30 or 40 years.